you find income right now, Ian?
So we would still gravitate towards the credit markets. We would still look at things like high yield credit. We like some of the bank capital within Europe. I think really, as we look forward, I don't think we can't completely dismiss the Delta variant and concerns around growth. And I think it's quite clear that we probably have had the peak growth in the second quarter. But the growth outlook does still look very positive as economies reopen. Some of the underlying data that we're seeing, out of the US, out of Europe, it all looks very healthy. Default rates in credit markets are collapsing. They're fundamentally very sound at the moment. So although spreads are tight from a historical standpoint, we still do feel that that's the place you want income. It's more of a carry game rather than a capital gain environment from a bond standpoint. But I think if you're an income investor, you look at 120 on the 10-year, you'd much rather buy the high yield market at around 4%.
So you mentioned default rates being really low, and they have been pretty low given stimulus low rates over the past year, despite the pandemic. And where are we in this cycle? Did we just skip the default cycle?
Yes, yeah. Again, it's something that we discuss a lot because it does feel like we've gone from sort of early cycle to mid-cycle in the space of a matter of months. Compared to a matter of years. We've seen default rates on the high yield space go from around 6%, down to about 2% on a trailing 12-month basis. It's likely to go lower. Most estimates, with a one handle. It does feel like we've really sped this situation up, and I think you're completely right. A lot of it's been the support that companies have had, support that the central banks are providing, and also obviously we've got big fiscal support as well. We've got unprecedented monetary policy, we've got unprecedented fiscal policy. It all bodes well for corporate health.
It also makes me think of Delta Airlines a couple days ago. In some of the excess cash they have, they've been using that to pay off some of their debt, which of course, a positive thing for their balance sheet and leverage picture. But I'm wondering, how long will this debt picture, the corporate debt picture, linger on? Are we going to continue to have companies putting their cash to work in that way versus capital expenditures?
I think at the moment, until companies can get a clear picture of the outlook and what's the next couple of years looks like, one of their main priorities will be to get leverage down. And I think it's going to be boosted in a couple of different ways because obviously they've got this excess cash. They can pay off some of their debt. Also, earnings are expected to be very strong for the remainder of the year. That should bring debt levels down. So again, from a leverage standpoint, from a fundamental standpoint, credit to us does look still very healthy.